markets have phases, and I didn't realize at the time I was in a seller's market phase 1 or 2, and things were starting to really heat up. Properties were going up, up, and up. Anything you bought, you're going to make money on as long as you sold.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Mike Murphy at JB Harrison Insurance, helping real estate investors to understand and choose their best options for all their insurance needs. Call 616-868-0050 or email mikem@jbhins.com. Hello and welcome to episode 152. My guest today has a really great story to tell, and really it's more of a cautionary story for real estate investors because he lost quite a bit of money during the Great Recession, and he's going to be talking about the factors that led him to almost lose his entire portfolio. We're also going to talk about how he rebounded and where he thinks we are now in the market cycle, whether or not we're going to see the next housing market crash and how soon that might happen. Kyle Zimpleman is the principal of Expand Capital Group, which purchases discounted mortgages, both performing and non-performing throughout the U.S. And I'm pleased to have him on the show today. Kyle, thanks for being here.
Hey, thanks, Brian. Yeah, I appreciate it. I've known Brian, I guess, since 2009. Is that when I first started? I was doing multifamily over here in Detroit area and promoting these crazy sales and deals that were available at the time, and also doing some stuff in Grand Rapids. So I think that's how we initially contacted each other. At least I contacted you.
Yeah, I have emails between us talking about some properties that you were getting rid of, one of which I ended up owning for about 15 minutes. I did a double close on it.
The one on Atwood, right?
Yeah, the Atwood 4-unit, yeah.
And that's an example of, if you take hard money and you got to flip a property, you can't hold on to it. And I wish I could have held on to a lot of these houses and properties, but you had to keep on flipping at that time because there was no financing other than hard money lenders out there. So, but my story, I guess, I won't say I was born in Grand Rapids, long story short is I got into real estate right out of college, out of Grand Valley in 1999. My plan was to get out of Michigan, get away from this weather, especially lake effect with Grand Rapids, cloudiness. So, but my dad was a real estate broker in a Remax. He actually brought one of the first Remaxes in the state in the early 70s. And he said, well, just give this a shot before you head off to, the great beyond or whatever. So I started getting into real estate at that point, right out of college. And I had two roommates with me that were both looking for places downtown. And Heritage Hill, it has these crazy places that, they look good on paper, but, you get into them and some of them are really run down or the prices just don't make sense. So I decided just to buy a house, and for 2 years they paid my mortgage. I only had them pay $300 a month.
So you started with the house hacking.
Yeah, house hacking, and got somebody to pay my mortgage right off the bat. Bought a house for $80,000, and we just drank beer and hung out in it. And then 2 years later, this is about 2002-ish. Sold it for $110,000, and I go, wow, this is where I need to be. Not just selling real estate, but I need to be owning real estate and building a college portfolio here. So I kind of started to look at what was available in the marketplace, and at the time, you could pick up a 4 or 5 bedroom house for $70,000-$80,000 in the Northwest or some of the parts of Northeast Grand Rapids. And if it had 1,500 square feet, I just would buy it. And I would try to put college kids in it. And luckily for me, all you really needed at that time was a heartbeat, and you can get a mortgage. Unlucky for me at the time too, as we'll get into. But so at the time, there was these 80-20 loans. So you do an 80% first mortgage, and then a 20% second mortgage at like 11% or something. And at these times, the rates were probably 6-7%. So you weren't cash flowing very well at that point.
Just so that 80-20 loan basically meant you didn't have to bring any money to the table. You were able to do both a first and second loan that would put up all the money you needed to purchase the property. Right.
So it'd be a zero down deal, and I would probably have to put a little bit into rehab or paint or something, but then just cash flowed. And if I made, $2, well, that's 200% or whatever it would be, So in my brain, I'm like I'm a genius. And that's kind of like this market cycle phase that, I wrote an article about that is the reason why you and I got to talking about it. But markets have phases. And I didn't realize at the time I was in a seller's market, phase 1 or 2, and things were starting to really heat up. Properties were going up and up, and so anything you bought, you're going to make money on as long as you sold. So my intent was to own these forever, build a big company around it. I was working on Fulton Street at the time, so I created Fulton Management. And not to be confused with Fulton Realty, which is out there now, but that's a different group. But so we bought tons of houses that way until we couldn't buy anymore, and refinanced out through like Huntington Bank and some other places to get out of those those 80-20s as much as we could, but just kept on piling them up until we couldn't pile up anymore. And then we went to the hard money lenders, which is very expensive money, but the idea was I was going to build this portfolio up, and then I would get a commercial loan or something like that to sustain myself long term with that. So this is kind of that build up phase to the market, building up, and everybody's making money. Some of the last few deals I did, I bought seven or eight houses all at once on a land contract. And I looked back at this investor who bought this stuff in the 1980s, and I saw what I was buying it for. So maybe he bought it for 30 and I was buying it for 100. And I did some quick math, and I go, wow, he made 5% every single year. That's just how real estate works. You buy it at, this time period, and you sell it at this time period, and you make money. You pay off the mortgage, and everybody's happy and rich. Well, that's not necessarily the case. So 2007, right around the start of 2007, I was dating a girl in the Detroit area, Livonia, Detroit area, and fell in love and all that fun stuff. And so I moved over to that side of the state. The idea, too, was to start building on what I've already done with the housing and start buying apartment buildings over there. And that's where all the apartment buildings were. So I moved over there, promptly bought a little bungalow house, which I shouldn't have done, and I didn't really want to, but the wife at the time, or I guess fiance at the time, was like, this is what you do. You buy the house, you get the dog, and blah, blah, blah. So now I'm in a little bungalow that I paid way too much for in Berkeley, Michigan, and I started to work for a company called Income Property Organization, early 2007, and then middle of 2007, end of 2007, that's when Lehman Brothers went under. 2008, other things happened around that time frame. The city of Detroit files for bankruptcy. Basically, the crap hits the fan. So
stop right there. Let's kind of go back and make sure we understand what happened up to this point, because this blog that you put out, you talk about the different cycles. Mm-hmm. And it's not just like the seller phase 1, seller phase 2, but you put emotions on them. Yeah. So what were the emotions leading up to this point? Obviously, there was a lot of optimism, but that optimism then becomes what?
Right. So I was very optimistic because of, you just saw appreciation, you saw rents going up. And so that's kind of that emotional driver too. It also feeds on itself. So you buy more or try to do better also. But the issue is that everything goes up must come down. And so middle of 2007, 2008 is when the cracks started happening. And the second phases of this cycle, start going downward, and it starts out with you going, okay, well, gosh, these opportunities out here, I should buy this, and you might even buy something on a small downturn, not realizing that it's not opportunity, it is the market starting to go down. And so the emotions of the time, I'm now in this house in Berkeley. I'm 2 hours from Grand Rapids. I've got 30 some houses in Grand Rapids that I'm managing not very well. And
it sounds like you weren't really getting much cash flow from them because you had so much debt on them.
Right. So they were barely cash flowing to begin with. And then putting a property manager in place, or at least a mom and pop in place, caused even less cash flow. And then repairs need to be done. And so about 2008, I got a call from my mom and pop property manager, and she's like, I'm not going to do this anymore. And here's the lease, and these two houses are not rented, and I'm out. So now I'm in more trouble here because it's late August, early September, which is not a good time to rent to college kids. It's a big 4 or 5 bedroom house. You can't put family members in there because it's just not going to cash flow. So now I'm losing money. It's 2008. The values are going down. I'm not sleeping well. And the kind of precipice to it was I went 2 or 3 nights without sleeping because, I'm straddled with a lot of debt. I'm too far away to really manage the stuff. The property values have gone down, the rents have gone down, and there's not financing to finance my way out of this. So I'm stuck. So late one night, I did like a crazy sleepwalking thing where I jumped over my wife, ran out the house thinking, I don't know what I was thinking, and got to, I lived on a corner lot, and there's a stop sign there, and I basically woke up to the stop sign, kind of like standing there by a stop sign going, okay, we've got a problem here. This is not going to solve itself.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. That's a pretty strong indication that you have a problem.
Yeah, that you
when you literally wake up by a stop sign.
Yeah, and it sounds like it can't be true, but if you ask my wife or my friends at the time, that it really did happen. Long story short, then I'm like, okay, well, I need to read books on how to get myself through this, And so one of the books I picked up was a Harry Dent book, which was a gold bug. He's a gold bug. He talks about basically deflation, and the only thing that's going to save you is gold. And so he's painted an even terrible picture of the economy and the market, and that we are just starting this, apocalyptic downturn. And so that kind of cemented in my mind going, I need to get some of these sold. So we sold off a bunch of them. I went back to that investor I bought 7 properties from, a land contract, and I had already put, I don't know how much money into these things. We tore up carpets, redid hardwood floors, you name it. And I said, hey, I can't sustain this. I paid too much. You want to work out a price, or do you want them to come back? And he's like, I'll just take them back. I never missed a payment with him, but he took them all back. So then we fast forward to
let's talk about that for a moment, because you basically cut your losses. You had, it sounds like you had a lot of money into these properties, but they were such a weight around your neck that they would have dragged you too far down. So in hindsight, do you think it was smart to just give them back?
No, because I probably should not have read that Harry Dent book. I should have read something else, because
should have read a
the
more
market went
book,
completely the opposite direction. It went on a tear from 2010 on into what we see now. I actually just looked at the GRAR listings or whatever else, and some of the old areas I used to invest in, which were at that time 60, 80, 100 grand. They're going for 190, 210. It just, I don't know how anybody that buys this, if they're buying for investment, are going to cash flow, because incomes haven't increased, rents really haven't gone up that much. So what are you buying for? Appreciation? Well, I'd be careful.
Yeah. I mean, it seems like those same emotions that follow the cycles are happening now. When it comes to rental property insurance, understanding the costs, choices, and benefits can be overwhelming, and finding the right insurance provider can be frustrating. I had one company cancel 5 of my policies all at once for no good reason, and that's why I'm happy to have Mike Murphy from JB Harrison Insurance on my team. Mike is an independent agent who has always been able to find the right policy and the best provider for my insurance needs. Over the past 5 years, Mike has not only become my go-to insurance agent, he's also helped me manage risk, add value, and save money. If you are looking for insurance on a new acquisition, or you believe it's time to get a more comprehensive look at your entire portfolio, then Mike Murphy is the independent agent to call for all your insurance needs, auto, home, and business, at 616-868-0050, or email mikem@jbhins.com. But I just want to argue your takeaway from that, because this was what, 2009 you gave those houses back?
Yeah, 2009, 2010.
Yeah, it wasn't just Harry Dent. It was everybody. Everybody in the media was saying the world was going to end. There was no way you could have known that had you held on to those houses, things would have turned around the way they did. And in fact, they may very well have not have turned around. So I would argue that for the time, given what you knew at that time, you probably made the smart decision.
Oh, I appreciate that. It's tough, though, when you go to Grand Rapids and you see all the new developments, and then you see what. So that guy recently sold those 7 properties, and he sold it in the 180, 190 range. Some of those are on Fuller Avenue, just by Lake Drive. Great rental spots, but so I would have doubled, tripled my money, whatever you want to call it. So long story short, yeah, that was a tough time. And in 2010, after this, some of the stuff dust had cleared off, and I had kept what I could keep that was cash flowing and still rebuilding my, I guess, portfolio. I started Expand Capital in 2010 and create a fund. And I thought, you know what? Everybody and their mom is going to want to invest in this. Everyone's going to see that these property values make sense and the rents make sense. Not the case. Every single person said, "Oh my God, real estate is terrible. You shouldn't invest in it. Look what happens if you invest in real estate."
Yeah,
well,
everybody had a story. Well, I have a friend who bought a building and they lost all their money.
Right.
Yeah.
And I couldn't tell him no, because I had lost money too, but I could tell him, hey, I'm looking at the numbers here. And the one thing I really did learn by working at a large brokerage like income property organization for multifamily is to really understand your numbers. That's one thing I guess you could tell any investor that wants to invest is know your numbers, know what net operating income means, know what capital expenses mean, know what your taxes are going to go up after you buy it because it's going to become uncapped. There's all these things that no realtor is going to tell you because they want their commission, but you need to know this stuff, because these numbers you think you're going to get, you're not going to always get. And every single thing that is sold on pro forma. Hey, this is what it could do. It's not what it is doing. From that knowledge that I learned at that company, That was also my introduction to mortgage notes, where these out-of-town California and New York guys were coming in, and we would have the apartment building, available, short sale, whatever, how we were advertising it. And they would say, well, that's great. We'll protect your commission, but we want to talk to the asset manager you're talking to and work something out direct with them. And one example of this was, I know it's Flint, whatever you want to call Flint, but it was 300 units, maybe 200 units in Flint that had sold in 2005 for $4 million, which is overpriced, obviously, at that time. And they bought the note for $400,000.
Wow. So these investors came in, obviously the note was distressed. The people who paid $4 million couldn't pay on the note. And these investors came in and they wanted to talk directly to the special asset manager at the lender to negotiate this. And they got it for basically 10 cents on the dollar.
And that's what things were going for in the note space that I came to know from now being in the field. The guys that were buying houses in big groups of pools, they were able to buy 100 houses for 10 cents on the dollar. Now it's going for 40 to 60 cents, depending on what you're looking at. When I say what we're talking about the unpaid mortgage balance, not what the property's worth.
Yeah.
So that's another.
So in other words, you're not buying the property, but you're buying the mortgage or the loan that's associated with that property.
Right. So at the time, I'm like, whatever they're doing, as long as I got my commission, I can at least get paid something here, because everything is going for super cheap because it's all cash buyers. There is no financing. Everybody that was buying apartments before that are usually on like these 5-year timelines where they have to meet with the bank, and the bank reassesses their loan. Well, when they reassess their loan, the appraisal comes in a lot less because the rents are off, and they say, well, we're going to need another $1 million from you so we can have this thing at 75% of value. And all these investors said, no, how about you just take the property back? So we're not going to pour good money after bad. And I think that's what really caused the apartment market to really go down as well. I mean, stuff in Royal Oak, which is a really good market, I guess you could compare that to, I'm not sure how you compare that, but it's going for 60, 70 thousand a unit now. It was selling for 25, 30,000 a unit in 2008, 2009. So people who bought then, if you got 100 units and it goes up double, it's a lot better than having one house go up double. So these guys just made a lot of money, and my thought is that this market is kind of showing the same symptoms that it's shown before, over lending, over enthusiasm, where everybody is just excited about what's going on, that all the real estate buy zero down classes are filled with people. It just mimics. And then the other issue is as the interest rates rise, the ability to buy is obviously going to go down. So why are we going to see more appreciation in the future? I just don't see it. So.
Yeah. And as the interest rates rise, do you think it will have an effect on the number of buyers who are out there?
Yeah, I mean, let's take a first-time buyer that's at in 2010 was at a 6% mortgage and wants to buy a $400,000 house which then goes to a 3% mortgage, for that period of time, 2010 to 2007, really low mortgage rates, trying to spur economy growth. And that's almost a lateral move for them. They don't even, some cases they'd be paying less to buy a $400,000 house and get out of a 6% mortgage than to stay in their house. So there was incentivized. Now they're at a 3% mortgage at $200,000, and they want to buy that $400,000 house, and now it's 5.5% or whatever it is now rates. You can't move unless you're making a lot more money, which people aren't. So I think the dominoes could be stacked against us for this market.
How would you describe the emotions right now in this market?
I think, if you talk to anybody, they're going to say, oh, yeah. yep, it's going to crash, or it's totally going to go under. It depends on what market you talk to, but everyone seems to feel like it's on the precipice again for this, because everybody wants to be the expert this time around, But I think that it will be a much shorter cycle because of that, because people like myself and others that were able to buy during that downtime and sold at the top peak are sitting in cash waiting for the numbers to make sense again. So the second they make sense again, people are going to buy quick, in my opinion, and the market will come back quicker. It won't be a great recession again, but it will be a blip, Mm-hmm. I just don't know how much. If I had a crystal ball, I'd be a lot richer,
Yeah. I mean, so it sounds like you've sold off everything and you're holding on to that cash, waiting for prices to come down to where you need them to be.
Yeah. So with my mortgage investing business, so Expand Capital has experience, like we talked about, in the multifamily, the college rental space, which is what I did in Grand Rapids, and most recently the mortgage investing space, which solves a lot of problems that I think banks are going to create. One, we solve the bank's problem because the bank doesn't want a bad note. They want this off the paper. They're not landlords. They don't want to work it out. They want to keep their money flowing. So we go to a bank or we go to a hedge fund or whatever, buy stuff, and we buy at a discount because it's non-performing. There's something going on.
So a bad note that's non-performing is basically a mortgage that someone has taken out that they are no longer paying on. It's become a non-performing loan.
Right, and we only invest in first lien positions. So if the worst case happens where we can't work something out with the borrower, we would get the house back, which is where the value is to us. That and working something out. So we'd never really want the house back because you don't know what the inside looks like. You don't know the condition. And what you want to do is you want people paying, you want cash flow. So the second problem we solve is borrowers are able to work something out with us 80% of the time, because if they got a job and they got to live somewhere, if the rent in the area says it's $800 and they're paying $500 a month for a mortgage, where are they going to go? So we try to work things out. We want families to stay in their houses so we can help borrowers in that way. Or if we moved, we got to get out of the state. Well, I can approve a short sale in a day, where other people, big banks could take months and months and years sometimes.
So can you give us an example then? It sounds like you've been buying mostly single family distressed notes.
Yeah. So I guess example, we've also bought distressed or discounted land contracts too. So in that space, they're higher interest rate, but they have larger equity positions. And so if they start defaulting and we've got our discount, well, we can lower their interest rate. I'll give you an example of a situation of an Ohio deal we bought. It was $7,000. She owed $42,000 on it, and I bought it out of a package of maybe 5 other notes about same price range.
So she owed $42,000, and you were able to pick up the note for $7,000.
Yeah, this is not typical, but so what happened was the bank or hedge fund I bought it from, they had no idea what was going on because she would not respond to anybody. No notice, no anything. Door knocking, everything went unanswered. So they figured, hey, they got a bad apple. They're going to have to just, they want to get out of the Ohio market anyway. They want to get into other markets. And so they just wanted to offload these things. So it wasn't exactly $7,000 because she owed $2,500 in back taxes. So I paid the taxes too. So let's say $9,500. So I bought, a package of Ohio deals. So I drove down to see what I got myself into. And it was a Saturday morning, and I knocked on her door. And I was like, hey. She opened the door. I said, hey, I own your house, kind of. What do you want to do? She goes, I want to stay here. My son had been in an accident a year and a half ago, car accident, and died. And she just lost all will to care about anything. So I said, well, I'm sorry to hear that. And what do you want to do? So she said, obviously she's not been paying rent or anything for a year and a half, 2 years. So she has some money saved up. She's working at a job that's making 35 grand a year. So she has to live somewhere. She has to pay something. You have to pay to stay. It's just life. So I said, okay, well, you need to make some payments here. So she made $2,500 in payments in 2 installments, and then she started out making $500 a month, and then most recently she fell back behind again. But then she also made another $2,500. So long story short, I've got almost all my money out of the property back. I was able to help her out. As soon as she can show me 6 months of paid history, I will modify her loan, but she keeps on missing payments, makes it difficult for me to do that for her. But as soon as I can do that, I will even lower the rates more. And then she owes $42,000, but the house is worth maybe $30,000. So I would lower it down to $30,000. I have all this room to play with. So that's one advantage. You can actually help people too, stay in houses. I said, what can you pay? It wasn't like, hey, you owe all this money. I need my money or I'm kicking you out of the house. What am I going to do? I want somebody living there. It's good for everybody. So
why? Let me ask you a question. Why couldn't the lender or the hedge fund that sold you the note in the first place? Why couldn't they have worked out a deal with the owner? Why couldn't they have gone and knocked on her door and talked to her like you did?
Yeah, I think what happens is it's a volume problem. We're under 100 notes. These companies also have service companies that don't care. They're going to get their service fees no matter what, whether the property is performing or not performing, and sometimes it just doesn't get back to the end person that can make a decision on things. And in this case, this was a hedge fund group that don't have the best name in town either, so they're not going to foreclose. They were going to let it go, so they didn't care. Because these groups also bought in 2010 at 5 cents, 10 cents in the dollar too. So they had room to.
Yeah, they had a lot of room.
A lot of room, right? So that's how we solve the borrower's problems. So we go to them, go, hey, what can we do to keep you in the house? How can we solve this problem for you? The investor problem, which is one I've never had before, is after 2010 and after creating my second fund or first fund, and we put a few dollars. I think we put $400,000 together. I went and started to rebuild my fund or refund my portfolio, and I got one of my doctor buddies and his dad to invest with me. And what we would do is we buy the properties, refinance them, and then just cookie cutter, keep it going. 4 or 5 bedroom houses. We did 15, 20 houses that way throughout Grand Rapids. And recently, 2017, my realtor I work with out there said, hey, I don't know if you know what's going on, but this market's been going crazy. I bet we can sell. And I had this really dumpy house on Emerald Street that I had owned myself for since the 2009. I bought it for $25,000. I couldn't sell it. I tried selling it almost every year since I bought it for at least a little bit more than I bought it for. And in 2015, I tried to sell it for $55,000. Nobody would buy it. So 2017 comes along. The renter moves out. I clean up the place, and I go, what are we going to list this thing at? $59,000, $69,000? He goes, no, we're listing this thing for $89,000. I'm like, whatever. So he lists it for $89,000. We get 7 offers. 2 of them are accelerated clause, which I've never even seen before. Accelerated clauses on this stuff that they'll pay.
What is accelerated clause?
Oh, so they say, okay, we'll buy it for $92,000, and we will beat the next highest offer by $100 up to a certain price. If another person comes in at 94 and they said, well, we pay $95 if we had to, I would have to show them the purchase agreement, and then they would step up to that price. Which I was like, what are people doing? This is not a great house to begin with. But long story short, I go, okay, it is time. It's 2017, start of 2017. It is time. This is basically the feeding frenzy of real estate again. And I've seen all this before. 2007, 2006, we were running out to houses to buy them and beating out other people into offers, trying to work, deals with the broker to, hey, you get both sides of commission, just let me in the door, And so we sold everything, which in the last 2 years, we took 2 years to sell them all. And then a bigger issue comes about. One is taxes. That's not good, because you can't do a 1031, because what are you going to do? Buy the same house you just sold, or are you going to buy the same stock you just sold? So we had to sell, and then we're sitting on cash. And that's when I started getting back into mortgages, going, okay, is there an opportunity in this space? I learned about it just briefly in 2009, and I went head first in early 2017 into this space. And it's great for investors because you have so many more options. I mean, I used to buy these frozen houses in Grand Rapids, in January, and I would put the earnest money equal to the purchase price. So I had no way out of this deal. The sight unseen, no inspections. The earnest money was equal to the purchase price. I had no way out. So that's risky. Now, this stuff isn't risky. You buy a mortgage note at 30 cents on the dollar and 30 cents on where they owe, whatever else, and it's worth 100. Even if they foreclose, even if the worst case scenario happens, you can always rent it. You can sell it. You can sell it at the auction if it goes to sheriff's sale. You can redo the loan, another loan. You can modify the loan. You just have options, which you don't have that many options in traditional real estate. So, and everything is basically funded by a mortgage. I mean, you think of every single opportunity out there, buying a house, buying a multifamily complex, you can't be done well without a mortgage. So mortgages rule the world,
Yeah, and since you're buying those mortgages, you don't have any debt that when the crap hits the fan, you have to give that property back or give that mortgage back to the lender. Because you are the lender.
Yes, and that's the flexibility right there. Is I will never be in the same situation that I put myself in 2007, 2008, whatever it was, because I don't play with debt. If I was going to buy a big complex, you're going to have to secure that with debt, mortgage. But for the most part, these houses, we just go in and out of cash. And we basically are the bank, is the easiest way to explain it. And what we buy, easiest way to explain it, is like a pre-foreclosure. So before the bank puts it all out there and goes through the whole process and puts it as a relo on the MLS, this is the back end stuff that people don't see. And this is the place that I want to spend my rest of my investing career in.
So if you're not getting loans from a lender, how are you coming up with the money to buy these notes?
Yeah, well, first, the investors I worked with when we made all the killing, I guess you could say, in Grand Rapids, they had the same problem. They didn't know where to put the money, so we created a fund. It's a 506c, so we're able to advertise. Has to be accredited investors, so people that are, I guess well funded, I guess you could say, or have more than $1 million or $250,000 they make, some sort of formula there. But that is the group we invest with, and they all have the same problem. Some of them they're all seeing the writing on the wall. It's almost like we're watching the storm come in from Lake Michigan, It's like, it's coming, It's going to hit us. You just don't know how quick that storm's coming. So, in my opinion, it's time to put money together as a war chest. And I'm not saying that we're going to go out and buy right this day, because it's same as the real estate market, the mortgage loan market and the mortgage loan discount space has gone up as well, because hedge funds don't really care to sell if the properties are going up in value and the interest rate is still accruing every single day. So they're in really good positions. When they get in the opposite position where the values are going down is where I think in the next 5-6 months we're going to see opportunities, maybe not at that 10-cent mark, but definitely where it is very difficult to get hurt in this business. The only way you're going to get hurt in this, in my opinion, this business is if you don't do your due diligence correctly at the start, and you don't have the proper chain of title for your mortgage, or it's something to where that happens, where you're not going to get stuck on the property if you do your due diligence, because there's going to be equity.
Yeah. So what is some of the due diligence you do on the properties before you purchase the note?
Mm-hmm. So very first thing that we want to do is you want to find out, okay, is there equity? Does the borrower have equity? Because you want the borrower to keep on making payments. You want to work something out with the borrower. If they are overextended already and underwater, it's going to create an issue because they're going to be not wanters. They're going to just not want the property. So you want a win-win situation. So you want the borrower to have equity, and then you want to have equity. So let's take a $100,000 example. If it's non-performing, so they haven't paid in 3 months, 4 months, 10 years, whatever it is, I would buy that maybe in today's market at 40 cents. And they would owe, let's say
40 cents of what? The unpaid balance on the mortgage?
The unpaid, let's just say 40,000 just for easy numbers here. But yeah, 40 cents, 50 cents. Every situation is a little unique, goes back to knowing your numbers and crunching, because I have to make a certain percentage for this fund to get past my hurdle, which is my investors have to make their 8% before I make a dime. So every investment we get into is on that metric in a way. So first you got to have equity. So that's step one. Is there equity in the property? Step two, what's the borrower's pay history look like? Okay, is this an isolated incident, or is this what somebody always does and then they end up paying again down the road? If that's the case, then maybe you work your numbers differently too, knowing that you might get paid up quicker too. So that's step one, is equity, the borrower history. Then you look at the collateral, which is the files. You want to make sure all the mortgage documents are there. There's nothing missing that a borrower could say, well, show me this document, and you don't have it. Or a judge says, where's this document, and you don't have it. You might have a tough time foreclosing on a property. And that's when I tell you, that's the way you get hurt. So we have our lawyers look over all the documents and give us the green light before we buy it. I have a host of realtors and service companies that drive by and take pictures, and we look at MLS previous photos to see what the property looks like in condition. And so that's how we kind of protect ourselves. And we're buying at a price that, worst case scenario, we've got equity. We don't want the house back, but if we got to do it, it's not anything new to me. I've been flipping houses for almost 20 years, so it's nothing new.
By the way, you talk about having realtors drive by the house to give you sort of an opinion on what they think the price would be. You can't get into the house before you buy the note. Is that correct?
Yeah, that's why you're not buying it at 70, 80 cents of value or the unpaid balance or whatnot, because there is that unknown of the condition. We just got through the doors on a property in, it's way down in Ohio, Toronto, Ohio, which I didn't think there one existed, but it was a nice little bi-level house, looked great on the exterior. We got in the doors, and yeah, it's going to need a full rehab. But I bought it for $30,000. The realtor was telling me fixed up $120. So I had an opportunity there. Now we found out it's all baseboard. It's not even baseboard heat. It's all electric heat. So she dropped that number to 100. Well, so we're going to list it tomorrow for 59,000, and I'm just going to hopefully just unload, sell it off to an investor
who wants to go through the process of rehabbing.
If it doesn't sell in 2 months, yeah, and if it doesn't sell in 2 months, then early January, I already got the quote for 25 grand to rehab it. I'll just rehab it and then sell it for 100 grand. Let's say the market goes down 10%, it's 90,000. I'm still going to make money. Let's say nobody wants to buy it. I can do seller financing. I could sell it on a land contract. I can rent it out. I mean, I just have a lot of options that are available.
Yeah, because you bought it at 30,000, your downside is pretty limited.
Right. Yeah, and it's in BFE, Ohio, but I had a realtor that does a lot of work down there. She got me in contact with the right contractors that do the job. So I mean, that's half the battle. But it doesn't always work that way. I've got a deal in Florida right now. I bought it a month before the sheriff's sale from the bank, and the day of the sheriff's sale, they filed a petition for bankruptcy. They don't qualify for bankruptcy, but they are trying to delay this thing a little bit. But
the owner who lives in the house filed for bankruptcy.
Right, yeah. Mm-hmm. And it's actually not a bad thing, because if they do a bankruptcy, if they do a 13, well, then you have to work something out. They have to start paying you money, which is all you really want is cash flow. Or they do a 7, they have to liquidate the property, and you've got equity there too. So some people get scared by that, but I'm like, all it does is delay things a little bit. It doesn't hurt us in the long run. Mm-hmm. So,
any success examples?
Yeah, I'll give you a quick one. I bought a group of properties early January this year, and about 4 months into it, they've been paying, and this one has never missed a payment. So it's a performing note that I bought at a discount from a hedge fund that basically these groups want to keep their money flowing. So they'll sell these things at a discount, plus it's land contract, so it's not as popular, I guess, as a mortgage paper, so you get a better discount. So we got a good discount on it. Let's just say it's 70 cents of the unpaid balance. So she owed 40 grand on it, and I bought it, or she owed 42, and I bought it for 29, somewhere around there, of the mortgage. And I was doing my QuickBooks, and I go, well, where's our monthly payment from her, And so I called the service company that's handling the note portion of this, and they said, well, we've got a check sitting here for $42,000. What do you want to do with it? I go, oh, well, I guess I want to cash it, So what she had done is she went and refied the mortgage. So when that happens, we get paid our total amount owed, which is what she owes on the mortgage, not what I bought it for.
So she owed 42. You picked up the non-performing note for what, 29,000?
Yeah, 29, and she paid 3 months of principal payments too, because these are high interest loans, so that it's mostly principal, or mostly interest. Mostly interest. So yeah, it's a beautiful thing if it can work out. The issue is that these deals are drying up because this is the end of this cycle, kind of similar. It's the same cycle we're in real estate. So to find these deals, you've got to create a fund, and you've got to go after, $1 million of property or of unpaid balances at a time, rather than these one-off, because they're just not out there anymore, or they are, and you're going, well, why is this still available? What's wrong with it?
And so, do you get better pricing if you buy multiple notes at the same time?
Yeah, for the most part, if the next plan is to go after some smaller banks, use some of marketing techniques to try to drum up sellers of notes, that type of thing too, where we can just make a really good return for everybody. So it's just, the whole idea here is that we are going to be protected by equity. The worst case scenario is probably the best case scenario, which is foreclosure unlocks that equity if we had to. It's not the intent, but it's kind of way things go probably 30% of the time if you buy a note, 40% of the time.
You never know what the homeowner is going to do, and they're in that situation for a reason. Sometimes they want to work things out and they do what's necessary, but sometimes they go dark and don't answer the phone.
Yeah, and sometimes you knock on her door and she just answers and says she wants to stay there. That's like that $7,000 deal, but that's unique. It's coming. And I guess what I want to kind of reiterate is you got to have a fund that to buy these things, and that's why I created the fund, because you're just not going to get anybody's attention from a bank or anybody if you say, hey, I've got $50,000, what can I buy? You're not going to be able to buy anything, As
we wrap it up, Kyle,
mm-hmm.
I'm wondering if you can just kind of give us again kind of your overview of where we are in this market cycle. I mean, you talk about watching the clouds roll in over Lake Michigan.
Mm-hmm.
What should people be cautious of, and what do you see as the dangers that are out there?
Any first-time buyer that is buying right now, not as an investor, just a buyer, hey, are you willing to be there for 5 years? If the answer is no, do not buy it. If you're an investor, are you buying from real cash flow numbers that actually have a cap rate attached? You can prove that it's going to cash flow, or are you buying on the fact that you think it's going to continue to go up? If that's the case, you should be very cautious right now, because all signs point to either stagnation or decline.
If people want to get a hold of you,
mm-hmm.
Whether talk about your fund or have any questions for you, how would they do so?
They can call me, or they can email me. Website probably is a starting point, which is expand, EXPAND, cap.com. My email, Kyle@expandcap.com. Or they can give me a call, 248-955-8222. That's a number I picked from my old realtor days, because it's easy to remember. So 248-955-8222. Yep.
That is easy to remember.
Mm-hmm.
I'll make sure all that is in the show notes too. Kyle, I really enjoyed talking with you, and I appreciate you sharing your story. I mean, you certainly had some incredible ups and downs. I think you're definitely sounding that cautionary alarm that I think is necessary right now, because we are definitely sort of in this sort of euphoria stage,
mm-hmm.
maybe at some point crossing into this anxiety stage,
mm-hmm.
which looking at the chart that you put together here. And by the way, you sent out this blog, and I keep referencing it. But if people contact you, is this something you'd be willing to send to our listeners?
Oh, yeah. Anybody that wants it, it's actually in my blog and my website too. So if you go to my website, there's probably, I don't know how many blogs, but some of them are just articles that either I've written or articles that just kind of, point to this possible market correction. I'm
looking at it right now, and you've certainly taken us through that sort of optimistic stage, to the excitement, to the thrill, to the euphoria, which a lot of people feel like we're at that now, which then sort of descends into anxiety, denial, fear, desperation, panic,
mm-hmm.
Capitulation, and then despondence.
Yeah.
And once we reach that, then we can start rising back up.
Yeah, we haven't even got to the oh crap, what did I do stage? For a lot of people yet,
Crap, what did I do? Let me unload everything right now.
Yeah. And I think it's coming, and I think as you have experience in the multifamily space, a 5 cap or a 4 cap just doesn't work. You're not going to win long term with that approach.
It's very, very hard to squeeze out cash flow and profit when you're paying a 5 cap, unless there's some incredible upside value that you can add.
Right. Yeah. If it's in one of the opportunity zones in Detroit or something to that nature, then maybe. But I'd be very, very cautious.
Yeah, definitely. Well, I appreciate you sharing all this with us. It's been a pleasure talking with you, and good luck with your fund. And thanks for taking the time to talk with us today.
Yeah, I appreciate it. Thank you very much.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Mike Murphy at JB Harrison Insurance, helping real estate investors to understand and choose their best options for all their insurance needs. Call 616-868-0050 or email mikem@jbhins.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.